Corporate finance presentation. Other forms of bond financing. Get ready, it's time to take your chance with corporate finance. Other forms of bond financing include zero coupon rate bonds and floating rate bonds. First, we'll take a look at the zero coupon rate bonds, which are bonds with no interest payment. So if you think about the bond, the components of the bond usually will include the face amount or par value, and then the interest rate and the maturity date. Well, we have no interest or coupon rate because there's no interest payments. Or in other words, when you think about the normal stream of the payments or the financing of the bond, you typically think of interest happening. We have to basically, when we calculate the price of the bond, take a look at the annuity or present value of the interest payments, as well as the present value of the payment at the end, which will be the principal or face amount at maturity. Well, in this case, there are no interest components to it. Therefore, they're going to trade at a big discount, offering the full face amount at the maturity. So meaning, because we don't have any of the interest payments and you're just looking at that maturity payment, if you were trying to value this and you used a similar method to get to the price, you would just basically be taking the present value of the end amount that you would get at maturity and not the interest component. And that would, of course, lead you to a price that's going to be far less than the face amount of the bond. So they're going to be traded or they're going to be sold at a discount when compared to the face amount. So the advantages to the corporation, you can get immediate cash flow, of course, this way, no cash outflow until the maturity. So this can be a benefit. You could think on the corporation side, you're saying, hey, look, I want the money. We would like the money now. We would like to finance it for as long as possible before having to pay anything back. So in this case, you're going to get less money up front, but you don't have to give that money back for a longer period of time until the maturity. You don't have, in other words, the interest payments that are going to be the outflows until that maturity date. So the difference in value at maturity can be amortized for tax purposes. So in other words, taxes, again, will kind of complicate the situation a lot here because you have a loan type of situation. And if there's a loan situation, you think, well, there's got to be interest involved in some way, because if there wasn't interest involved, if there wasn't interest, as the incentive or the rent on the purchasing power, then there wouldn't be a transaction if it was an arm's length transaction. So you're going to have to impute the interest in some way to basically record it. And note, that's kind of a good thing on the corporate side, because one of the reasons that you do debt financing as opposed to equity financing is that the interest, the rent on the money, is deductible. So you want to be able to take the interest, any interest that you can claim, and basically get the tax advantage, which would be the expense or deduction of it. Advantages to investors: can purchase at the discounted price to receive the full amount at maturity. So on the investor side of things, you might be saying, hey, look, I would like, I'm doing a long-term investment. I would like to basically just get the full amount at the maturity point, and that means I'm going to invest at this time and I'm going to put less money in because I get to purchase it at a steep discounted amount because I'm not requiring the interest payments. I just want to get the payment at the end. So if, for example, I'm investing for retirement, in that situation, you might say, well, I don't need the interest payments. That's not helpful. I just want to basically get the full amount, get the full benefit at maturity. So that then could be beneficial because you can have a cheap discount to pay for it and get the full amount at maturity. The problem, though, is that the annual increase in the value of the bonds may be taxable as ordinary income, and the prices can be volatile as well. So this is, again, the IRS, from the IRS's standpoint, they're basically saying, hey, there's no such thing as no interest that's going to be involved here. So from the investor standpoint, you might end up having to basically calculate what the interest, impute the interest again and record that as income from the tax basis purposes, which kind of negates some of the benefit that you would have. So you'd have to weigh that so the taxes kind of make it not as attractive as otherwise it might be. So notice, if you can compare that to a normal bond, another kind of bond, then you would actually receive the interest. In a normal bond, you'd be being paid interest periodically. And although you might not want it yet because you're trying to save for retirement, which is 20 years out or something like that, if you have to record it in income anyways, you can basically take that interest payment and reinvest it, would be your other option, just reinvesting the payments that you would be receiving. So the floating rate bonds, we also have the floating rate bonds, has a variable interest rate. So the interest rate will now change. So if you invest in the floating rate bond, then you're going to have that change in the interest rate. Now, most people probably have an idea maybe from the individual side of people investing or having a floating rate with regards maybe to a mortgage or something like that, which from that side is usually kind of a risky kind of scenario, right? If you invest and you have a mortgage and that's floating and basically the interest rate goes up, then all of a sudden you might owe, more money because there was an increase. But if you're on the other side of the transaction, on the financing side of the transaction, you're the one that purchased the bond in this case and gave the money to the corporation. The floating could be on the good side in order to lower risk to some degree, because if the market if there's inflation or whatnot and the interest rates goes up in the market, then they should be required hopefully to pay you whatever the market price is. So as the interest rate changes, you hopefully will not be locked in that case to the lower interest rate. If there's a inflationary period, hopefully you can take advantage of those higher markups. So the interest rate is tied to the short-term benchmark like the LIBOR, the LIBOR, the Fed funds rate, plus a quoted spread or rate that holds constant. So you might say, well, how does the flotation thing work? Well, they're going to have to link it to some set rate, like the Fed funds rate, which will be, that will be announced, right? You'll know what that is. And then they're going to say, well, whatever set amount above that rate is. So if they say it's, 1% above that rate, then that percentage above the rate will remain constant, and that rate that changes will be dependent on something outside of the two parties involved, such as the Fed funds or the LIBOR rate. So many will have quarterly coupons, meaning they pay interest four times a year. So you might see these floating type of bonds paying quarterly, although that could be different. Investors may be able to get a constant market value for the security, even though the market rates change. And that's going to be kind of the idea, that it'd be nice if you can invest and say, hey, especially if the rates are low right now and you're expecting inflation or something like that, if when the inflation goes up, the amount will go up with it, so you don't have to constantly be refinancing or shuffling the bonds, would be kind of one of the ideas with regards to a floating rate type of bond. Obviously, on the corporation side, they're taking on a bit more risk on the corporation side, because on their side, you have the situation where if they issued a floating rate bond and there was a period of high inflation and whatnot, their financing could suddenly become a lot more expensive. Just like in a floating kind of mortgage type of situation, if the market went up and you had a floating mortgage on it, you have the risk of the interest payments or the payments going up.